Welcome back. You're watching Stock Watch this weekend. Joining me to unpack your stock-related questions this afternoon is Chantal Marx from FNB Wealth and Investments. You can send us your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, Chantal. I was actually thinking, because we are seeing so much potential corporate action on the JSE, so many companies wanting other companies. Is this a signal of just how cheap our JSE companies are at this point?
Yes, so it's actually been something that's been taking place for quite some time. The JSE has been perpetually undervalued, it seems, but more so over the last 5-6 years. It's not only a phenomenon of the JSE, we are seeing it in certain other markets as well, most notably in the UK. So one of the reasons why we are seeing this is because it's cheap, and one of the effects of that is that we're seeing a shrinking JSE. So I know that that's been something that's been very topical as well. But the JSE is shrinking because the assets are too cheap to ignore. So they get taken out by either foreign players or they get taken out by guys locally.
All right. Yeah, very, very interesting. And of course, we're waiting to see if those deals actually come to a close, specifically talking about Anglo-American and also Vukile and New River now wanting a capital and regional. Just talking about Anglo-American, because they have given BHP an extension, seeming that the language has changed a little bit there from an outright rejection to we're willing to actually talk. What do you think BHP, the opportunity that does still exist for them to actually convince Anglo-American? Because, I mean, Anglo-American has said, we're not getting rid of Kumba.
Yeah, so I mean, I don't think it's going to take much from BHP from this point out. The last offer was pretty decent. The only thing that I think investors want to be compensated for, and Anglo-American's board is thinking about right now, is that this is going to take a really long time to get this thing across the line. So you have to compensate investors for the fact that they will be stuck in the share for a while without it going anywhere. There's an opportunity cost attached to it, right? And then there's this change of control premium that they're talking about as well. Now, the last offer does give you a little bit extra above what's been kind of reported to be Anglo-American's fair value. So I think if they can sweeten it a little bit more, perhaps with a small cash component, they might be able to get this over the line, even with the insistence of unbundling Kumba.
So wait, do you think that BHP would actually take Kumba, or would Anglo now have to be the one that kind of steps back to be like, okay, it's fine, we can get rid of Kumba if you can sweeten, this deal?
Yes, so I don't think that BHP is interested in Kumba iron ore. It's just, it doesn't fit into their portfolio. So they have big iron ore exposure, but they have no exposure to the South African market. So they are going to unbundle the PGM story. They don't have any access to PGMs. So there's essentially only going to be Kumba and De Beers that they're likely going to flog at the first at any offer, really. So having this lone asset in South Africa just doesn't make sense to them. So I think they'll continue to want to have Kumba unbundled first. And the opportunity is there, right? It's already listed. It's an easy process.
All right. Well, one of the companies that investors have their eyeballs on is Pick n Pay. They released a trading statement and an update in their progress in the rights offer and also the unbundling of Boxer. I have actually seen the share still trading in a green territory, even though, of course, they're swinging to a loss. They are releasing results on Monday. Is there any position that you're taking on Pick n Pay ahead of these results?
Yeah, so I mean, I think that a lot was said in that trading update. So there's a reason why the share price has done well post that update. The first thing is that sales momentum was maintained and was positive. So the growth in the top line is still there. The second thing is they're essentially going to kitchen sink this set of results. So most of the bad stuff will be included in this result. And then they managed to bring down debt. Even though things are not going their way at the moment, they still managed to make make quite a big dent in their debt and exceed their own forecast that they put out to the market a few months ago. And then you have the prospect of having to go through a rights offer. Okay, that's not great for investors, but they'll have to put their money behind the company if they're already invested. You don't want to be diluted in that situation. And then you have the Boxer IPO, which I think can really help their balance sheet and probably put them in a much firmer footing to grow that troublesome core grocery business from here on out. So I think that there's a lot to be excited about. That said, this is a high risk story. There's a lot that needs to happen. Again, you have a lot that can go wrong. You've got execution risk in executing this plan. There's a chance that the core grocery business cannot be fixed. So it's a risky one. I'm behind them, but I'm an eternal optimist, right? So I'm behind this management team. I do think that they can turn this around, but it's going to be a bumpy ride.
Well, that's the thing, a bumpy ride, and you're also talking about this dilution that will come from the rights offer. If I'm an investor who's not in there at this, would it be a good idea to actually go in now before this rights offer?
Yeah, it's such a tough question. It shouldn't really make a difference. Just know that if you are going to get involved with Pick n Pay right now, you're going to have to participate in that rights offer, which means you are going to have to make a further financial commitment to the company. If this whole thing confuses you and makes you uncomfortable, rather just wait for after the rights offer. Because it's going to be quite volatile, I do think that you will get entry points post the rights offer as well.
All right. Well, talking about another company that really has had to clean up a house, Transaction Capital, they came out with numbers this week as well. Also did an unbundling of We Buy Cars. Do you think that most of the bad news is in already, or there's still some risk? Because they did also say that we shouldn't look at the fact that they made a loss because of the headwinds that SA Taxi is still undergoing, but that we should look at those numbers from the point of view of the strategic process, progress that they've made.
Yeah, I mean, so it was absolutely an awful set of numbers, and what's happened at SA Taxi is pretty close to a disaster.
Yeah.
One of the things that stood out for me in that specific statement was the fact that they're really close to getting their lenders on board with a new restructuring and kind of recapitalization plan for SA Taxi. Because one of the big reasons why SA Taxi continues to perform so poorly is because they can't actually lend at the rate that they want to lend. They have to conserve cash at the moment because they're at odds with their funders. You have to get to a situation where funders are backing this business so that they can resume a growth path going forward. I'm still a little bit nervous around this one. I think there's loads of value in Transaction Capital still between Newton Gomo and SA Taxi. But again, it's a super risky story here, probably a little bit more risky than the Pick n Pay story, because I don't think Transaction Capital can come to market and ask shareholders for money right now, where Pick n Pay has that option. They don't only have to have this huge deal with their debt funders. They can actually come to market.
That is actually a very, very interesting one. Just seeing, just the gravity of the pressure that they've taken, that actually it's not an option to actually come to the market. Maybe also just signaling and putting into perspective that at least Pick n Pay still does have that opportunity. Let's go into property. There's a question here. Please, can you look at storage, property REIT and Equites? These are... Not a lot of people have actually been talking about them recently. They were quite big news during COVID, when everybody was storing away their things, and obviously logistics is one of the parts of the property industry where investors are more optimistic about. Do you have any views on storage and Equites?
Yes, I like both companies. There's that. But both kind of operate in niche segments of the property market. So storage specifically is in self-storage, but they've got these beautiful storage arees that you find like on Jan Smuts.
On William Nicol,
It's right here. You can go in. It's beautiful. It's clean. It's neat. You don't feel unsafe. Because I'm saying that in the context of self-storage generally isn't perceived to be a safe
Yeah,
area.
no,
I've
seen.
watched enough movies to know that it's dodgy, and
Yeah.
it's not the fact with storage. And I think that they've done such a beautiful job with differentiating themselves in this market. And what I also like about them is that they tend to be apathetic to this to economic cycles, because they are exposed to the 3Ds. The 3Ds: death, divorce, disaster. So this is a area of the market that is completely different to other property companies, and I think such a nice, stable income generating asset to put into your portfolio.
All right. And Equitas?
Yeah, I mean, so Equitas has been through a pretty tough time. They went in quite hard into the US development space, or UK development space, and a lot of stuff happened in the UK. COVID happened. A lot of things changed. Funding costs changed. The structures through which they were buying these assets changed, or developing these assets changed, and they had to take quite a big hit a couple of years ago. But I think that is now pretty much in the price. They basically built these massive warehouses that are used as distribution centers mainly, as well as data centers. I do think that you're going to continue to see growth and demand for that. So Equitas is a company that I also like. It also it trades on a pretty decent forward dividend yield. And I think that you are actually able to pick up a high quality asset at not too expensive levels, because of some of those strategic mistakes that they made a few years ago.
All right. There's been actually quite a lot of questions on Southern Sun. And yeah, basically Southern Sun, Tsogo Sun Gaming, and City Lodge. Quite an interesting group there, seeming that Southern Sun is the clear outperformer there, with Tsogo Sun Gaming. They're just showing a lot of pressure as they released results yesterday, but also people talking about City Lodge in relation to the stake that Tsogo Sun Gaming has on that. Firstly, what are you making of Southern Sun's outperformance, and of course the fact that they also declared their first dividend as a standalone company?
Yes, I think it's totally deserved, the positive feedback that they got on their results, because it was exceptionally strong. One of the things that they've been benefiting from is a resumption of international travel, and really Cape Town as a premium destination and a pretty important international travel destination over the last few years. So they've been benefiting from that. But additionally, because they were struggling through COVID-19, they removed so much excess costs and inefficiency out of their business, that basically revenue growth is filtering through straight to the bottom line. They've managed to clear a lot of debt as well, so they get that kind of sweetening on the bottom line as well. And I think that they are very well positioned to grow further from here, particularly in some of the areas of the South African market that hasn't fully recovered. I'm thinking about domestic travel amongst kind of middle class individuals. I'm thinking about the conferencing sector that still hasn't fully rebounded. So yeah, I'm really positive on Southern Sun. The stock still doesn't look particularly expensive relative to growth expectations. Tsogo Sun Gaming, on the other hand, very exposed to the South African consumer, very exposed to pressure on disposable income, and I think very exposed to the load shedding story. I didn't realize just how huge it would be for them. But I mean, if you go to a mall and you want to sit in a Galaxy Bingo and the lights go off for 4 hours, I mean, you're not gonna wait around. And what they noted is that people actually fundamentally changed the way that they entertain themselves because of this. So yeah, they need to get through this specific period. I do think that there is a chance of a cyclical recovery, particularly into next year for Tsogo Sun, and some exciting things on the cards. I mean, if they can get a new casino going in the Western Cape, I think that could be a really exciting growth area for them.
You know what, it's quite interesting that you say you didn't realize the impact that load shedding would have, because for example, Sun International, they always say in their physical brick and mortar gaming casinos that they actually do struggle, but I think a lot of us just overlook it because Sun International also is just very diversified. So you don't actually see the full impact of that as we have seen on Tsogosan. Just lastly, before we go to your stock pick, City Lodge, because also there seems to be concern that Tsogosan Gaming also got the stake in City Lodge. It might have been a mistake. Do you think that also City Lodge is seen as falling behind because of the fortunes that Sun International and Southern Sun have experienced?
So I don't think so. I think City Lodge is being horribly overlooked right now. I mean, we haven't had an update from them in quite some time, and it almost feels like the market has forgotten about City Lodge. And City Lodge is not the same business that they were pre-pandemic. It's very important to note that. City Lodge used to be aimed at like, where do you put Granny when she comes to visit? And, oh, I quickly have to pop over to Durban for a conference. Let me just stay close to the venue. It was a budget kind of travel story, mostly aimed at business and convenience. But they've really worked hard to make their hotels more beautiful, more accessible, and more of an experience. So their food and beverage offering alone has been driving their growth so strongly over the last few years, and it really has changed the way that clients perceive City Lodge and the experience that they get there. And I think that there's still much more to come for them.
All right. Yeah, indeed, I do enjoy also that food and beverage offering as well. Really different experience from what you used to get back in the day. Let's get to your stock pick now, Chantal. What are you choosing?
Yes, so I mean, I've been combing through the SA Inc. stocks because we've already started seeing the SA Inc. trade into and post-elections become the consensus trade. And we've seen a lot of these stocks run quite hard already, but there have been a few laggards, particularly when we look at the large cap space. So everyone's been looking at the mid caps. The mid caps have been doing well, even the small caps, the retailers, the banks. But what about poor Bidvest? So we have started seeing a little bit of a recovery from Bidvest, but it still trades at a pretty cheap multiple currently. I think that this could be one of the companies that actually gets a lot of flow in a post-election scenario. I do think that they're exceptionally well diversified. The businesses are very, very interesting, and the company is exceptionally well managed. They are prudent capital allocators, and I think a pretty safe option going into elections.
All right. Well, thank you so much for your time and for your analysis today, Chantal. Really appreciate it. That was FNB Wealth's Chantal Marx.